Welcome to Scope's Portfolio Manager Conference session. My name is Manqing Sun, Mutual Fund Analyst from Scope Analysis. For today's session, I'm very pleased to be joined by one guest speaker, Mr. William Russell, Global Head of Product Specialist Equity at Allianz Global Investors. He's joining us on the line this afternoon from Hong Kong. Good afternoon, William.
Hey, Manqing. Good to be here.
So our discussion today is featured a segment of Scope's Asia Investment Special Series 2021, which was kicked off with a panel discussion in April. This time we'll further zoom into China, an emerging core asset class that is now under great spotlight. Here's how the hour is going to work. We will break it into two sections where Willem will first walk us through the landscape overview of China equity market, how it is evolving, along with a snapshot of Allianz Global Investors' China equity strategies, which impressively has always made it to the top performer list over the past years. So following that, we will have a Q&A session including many questions that our investors audience are most interested in. For example, the China-US relationship, Beijing steps up scrutiny of the tech sector, recent market correction, etc. That's why I would like to encourage all of you to write down your comments or questions. I'm sure William would be happy to take them. The whole session will last about 45 minutes. You could also view the full clip of replay on our platform, Scope Explorer. So without further ado, I shall now give the floor to William. And to get things started, William, please, can you tell us about yourself? And for the record, I had a small chat with William prior to the session, and I find his Mandarin pronunciation is impeccable, even with a dialect, I would say. So, William, what is your background relevant to this particular region and asset class? What is your role in Allianz Global Investors?
Thanks so much, Manqing, for your very kind introduction. Good morning, everyone. It's a great pleasure to be here. I am based in Hong Kong, as Manqing said. I learned my Mandarin actually through a combination of time when I spent in Taiwan and Beijing quite a long time ago. My background is that I was previously an Asian equity portfolio manager, and I've been following and investing in China for around 30 years. My time as a portfolio manager was in the 1990s, and when I think back to the situation then, I see quite a few similarities with the world today, in the sense that people look to China as a future economic power back then, just as they do today. Of course, in the 1990s, China was only quite recently opening up to the world in an economic sense. But even so, then, like now, there was this sense of country with a huge amount of potential to fulfill. What is very different now, though, and why we call this presentation towards a new asset class, is the situation for equity investors. For a long time, there was only a relatively limited set of China stocks that were listed here in Hong Kong. Often these were in quite mature industries, telecoms, banks, state-owned enterprises, industrial sector. So the investment options then weren't a good reflection of the overall China opportunity. But the situation is very different now. The opening up of the China A-share markets, those are stocks listed in Shanghai and Shenzhen, completely changes the whole situation. So it's possible to build a diversified portfolio of China equities that give access to many parts of China's future growth potential in a way that was never possible before, and therefore is a real game changer for the China equity asset class. So that's a bit about my background, Manqing. And shall I just take it away and go into the presentation now?
Yes, please go ahead.
Fantastic. Thank you so much.
Thank you.
So just to build on what I said, we'll have three separate parts to the presentation. The first is just a refresher on the China equity markets and this trend that we see towards a gradual institutionalization and improvement of market frameworks. A little bit on the outlook for China equities. We obviously had a great last year. They've been bumpy this year. So where do we go next? And then touch briefly on the Allianz China equity strategies. So a quick recap on the China equity universe. On this slide, you'll see four bubbles, and the bubbles represent the size of the market very roughly. So you'll see two big green bubbles, that's Shanghai and Shenzhen, and then slightly smaller bubbles which are representing China stocks that are listed in Hong Kong and the US. And in aggregate, I would just make the point that this is a very diverse, a very deep, and a very dynamic asset class. There are about 200 new companies that list in these markets every year. In aggregate, the market cap is about 19 trillion US dollars. That is the second largest equity asset class in the world after the US. It consists of almost 6,000 companies. And within this, I think it's very noticeable that 70% of the market cap are China A shares. So the point to leave you with on this slide is if you don't invest in China A shares at all, you effectively miss around 70% of the opportunity set in China. Now, despite the fact that the China equity asset class is extremely big and the Chinese economy is the second largest in the world, what we see is a very significant mismatch compared to the weight that China has in global indices. So a couple of reference points on this chart. China GDP at the end of 2019 was around 16% of the total world GDP. It's going to be a lot bigger than that now. And a particularly interesting point, I think, is this blue bar in the middle. 21.7% of turnover in stock markets globally comes just from China A shares. And that gives you a flavor of the size of China A shares, but also a sense of the shareholder base, a very retail-oriented shareholder base, private investors like you, me, Manqing, who have a very sort of short-term, momentum-driven investment culture and investment horizon. And this is what gives the China A share markets their very distinctive characteristics. On the right-hand side, you can see a weighting of China in the MSCI AC World Index and the US. The US weighting is 55%. China's weighting is about 5%. The reason this gap is so large, one of the reasons, is because China A shares have only very recently started to be included in MSCI indices. Over time, this gap will close, and very likely 3 to 5 years down the road, the China weighting will probably have become something in the region of 10%. So double what it is now. But I think the point here is that China's weighting will almost inevitably rise, and this gap between China and the US will shrink. Now, if China does grow to be 10% of the world indices, it becomes the second largest equity sort of country block in the world. And I think what that means is, in the same way that you think about allocating to the US, or you might think about allocating to Japan as a kind of separate asset class, gradually, I think momentum will build towards thinking about investing in China as a separate asset class, rather than including it in, for example, an emerging markets portfolio. Now, what the inclusion of China A shares into global indices has done has started to encourage a very significant shift of global capital into the A share markets. And one way of looking at this is on the left-hand chart. This left-hand chart measures the net buying through what is called the Stock Connect scheme. That's the mechanism that foreign investors buy into China A shares since this mechanism was launched back in 2015. So on an aggregate basis, you've got $200 billion US net of flows in. And if you think about it, these last 5 years, we've had some pretty volatile periods. 2015 and 2016 was very volatile in China. We've had US-China tensions. We've had COVID. We've had recent market weakness. And despite all this, on May the 24th, so just a couple of weeks ago, was the single largest global investor inflow into China A shares. And I think what this points to then is a very structural trend. Investors realize that in their portfolios, they are unconsciously almost underweight China relative to the size and scale of the economy and markets. And therefore, we're probably at the beginning of what is quite a sustained journey over a long period of time, where global portfolios start to catch up. And on the right-hand side, this is interesting because these flows from foreign investors mean that global investors now have an increasing influence as a marginal buyer in the A-share markets. Still relatively small, 6 to 7% of A-share turnover, for example, but I think the direction is very clear. And the thing about this is what is driving the gradual institutionalization of the China A-share markets. Now, what do I mean by that? I mean, a lot of steps taken over the last 5 years to improve the regulatory framework, the market structure, and here, as we show also, changes at a micro individual company level. So we show here the number of China A-share companies with employee stock ownership plans. And again, you can see a very clear trend. And the reason that this is important is because it starts to more closely align management incentives with the priorities of their individual shareholders. Now, we all know that corporate governance is a very big issue in China. Corporate governance standards are not what you have come to expect in Western or more developed markets, but the direction of travel to us seems very clear, and this is one proof statement. And a final point on the characteristics of China's equity markets are these low correlations. So this is a heat map that shows the correlation of one market related to another, and we've highlighted China A shares at the top. And if you look along to where China A shares intersects with European equities, you can see the figure is 0.2. In other words, 20% of the time these markets move in the same direction, and 80% of the time they move in different directions. And I think just the sense of how markets have worked as we go through COVID just reflects this and almost reinforces this. And of course, the point is about these low correlations is that they can offer diversification benefits to portfolios, and therefore adding to China A shares in a global portfolio has the potential to enhance the risk and return potential. And this is a characteristic of A shares that has been in place for a very long time. It's there because 80% of the daily turnover in Chinese A shares is through the private individual investors in China. And I don't think this is going to change in a hurry. So it's been a very structural feature of A-share markets. So that's a quick summary of the key features of China A-shares. Now, just turning to how we see the outlook. This chart shows 4 lines on it. And it's the performance of markets as we move through the COVID experience of 2020. You see the yellow line at the top is China A shares. The green line below it is offshore China equities, and then the blue line is the S&P, and the line at the bottom is MSCI Europe. And the experience through 2020 was a very unusual one, because when you get into situations of global economic crisis, as you know, that there is usually a tendency to run to safe haven assets. And safe haven assets, US dollar, US treasuries, US equities, for example. It's unusual for emerging market equities or China equities to outperform in a period of crisis. And not only did they deliver stronger returns, but you can also see in this little box that there was a significantly lower volatility. So the number of days in 2020 when the China markets moved by plus or minus 5% was 2 or 3 days, and we had 10 such days in the S&P. So here, clearly something has changed structurally compared with before. And this has everything, I think, to do with the way that China's handled the COVID situation and the resilience of the Chinese economy as a result of that, compared to what we've seen in other markets around the world. So that was looking back to last year. Now, what's been going on more recently? So here we have the same four markets, but clearly year to date, and this takes us up to the end of May, We have the two China indices, which have been lagging, and then the European markets that have been leading the way together with the S&P. And in particular, we've seen this period of profit taking that happens straight after Chinese New Year. We've highlighted it here with the dotted line, because we had a situation where China markets continued their momentum into the new year before seeing this period of profit taking. So the question here is what is going on? In some ways, I think of this period of weakness. It's kind of ironic to me. China's economic policies through the COVID cycle, if you like, have actually been amongst the most orthodox of any country in the world. And therefore, as the Chinese economy recovered in the second half of 2020 and into 2021, the policy reaction in China was to tighten. Monetary policy and fiscal policy to prevent an overheating of the economy. And we show it on this chart here, total social financing, which is effectively a measure of credit growth or liquidity conditions. And you can see that through the period in 2020, this blew up. In other words, there was accelerated credit that was pushed into the system. And then as the economy recovered, credit started to tighten, and this blue line turns down again. So it has been this tightening of policy, and fears that there would be a further tightening of policy if, for example, inflation pressures continue to build, which were the trigger for the profit taking. But I think the key here is that this has, in our view, been a period of profit taking and a kind of resetting of expectations, rather than a fundamental reset or change in the equity market outlook. And it's a result of very prudent measures, particularly, I think, in comparison to some of the central bank action that we've seen in the rest of the world. And what gives us confidence about the long-term outlook is the kind of fundamental underpinning of the economy. So here we have two pictures: Chinese New Year 2020 and Chinese New Year 2021, and quite a contrast. And I think it's been very apparent for the last probably 9 months now, while China has been returning to business as usual, and to a large extent normality within the country. This has been in stark contrast to the rest of the world, where obviously it's been a period of severe lockdown and economic dislocation. And this economic resilience leads to a pretty supportive outlook for earnings growth. We've just gone through a Q1 reporting season, which was very encouraging, and therefore structural growth that we expect to continue into the future, and therefore to support future market returns. And thinking about future market returns and structural growth drivers, just want to highlight three particular aspects. And the first we've chosen to look at here is the rise of domestic brands. A number of ways of looking at this, but I think broadly the product quality of Chinese companies has improved in leaps and bounds over the last decade. It used to be that if you wanted quality in products in China, you almost had to buy foreign products about 10 or 15 years ago. But now this quality gap has closed, and domestic companies have a natural competitive advantage when it comes to servicing their domestic client base. So to think of smartphones, it used to be Apple and Samsung that dominated, and now Xiaomi, Oppo, domestic brands have close to 90% of market share. In sportswear, Adidas and Nike are increasingly challenged by names such as Li Ning and Anteil. And these names are often not very common outside China at all. Many people have never heard of them, but they're very dominant brands in the local market. And what this increasingly means, if you need to invest into these local companies, if you are to capture the growth opportunities in China. The middle column here, China as a green pioneer. I mean, a few years ago, you would have almost laughed at this if you remember those pictures of smoggy Chinese cities where you could barely see a little way in front of you. But things have changed very significantly in China. There are sort of well-publicized plans to have peak carbon emissions in 2030 and carbon neutrality in 2060, which are very challenging goals because China is the largest CO2 emitter in the world. It has about 30% of total world emissions at the moment. So this is going to need a very significant restructure of the Chinese economy, which has to a large extent been powered by investment in heavy industry and users of fossil fuels. And China needs a very big restructuring of the economy, which is the reason it's been the largest investor in renewable energy, for example, over the last decade. So the outlook for solar and electric vehicles is particularly promising as we move away from areas such as fossil fuels. And the final point here on the right-hand side, quite often, I think previously, if you think of the phrase made in China, you might have thought of things like fake Rolex watches or cheap plastic toys. And this was at a time when China's labor was very cheap, had a very big competitive advantage, making big stockpiles of things and selling them abroad, as we all know, very cheaply. That labor cost advantage has gone, and China is increasingly having to move up the value chain and to become far more innovative and in the way that it develops its industry. And we put here one example is healthcare. I think it's entirely possible that we move from a situation now where, you know, every time you think of a world leader in pharmaceuticals, whether, you know, it's in the headlines now, Pfizer or AstraZeneca, and I think in 5 years' time, the next Pfizer or the next AstraZeneca could well be a Chinese company. So this is kind of just thinking ahead about some of the structural drivers, and happy to have a Q&A, of course, on this in due course. Final comments to make on the Allianz China equity strategies. We've been running China equity strategies for more than 25 years here in Hong Kong. Highlighted 3 strategies on the right-hand side. China A-shares, our flagship strategy, all China equity, which is a balance of around half in China A-shares and half in offshore China. So it's the whole spectrum of China equities. And then China A opportunities, which is our latest product, which we launched in January this year, and is focused on China A-shares more on a mid and large cap perspective. Now, I just want to share with you quickly the kind of common underpinning to the way that we think about running each of these products. But for me, the most important criteria in China is selectivity. There's a very wide range of quality of companies. As I said, corporate governance standards are lower, and therefore, although there are 5,000 to 6,000 listed companies, you have to be very selective in which ones you pick within those. So based on the ground here in Hong Kong, we do about 1,500 company meetings every year, a very high level of due diligence. We have a proprietary tool that we use called Grassroots to get on the ground intelligence. And we do everything we can to analyze companies and assess the risks and opportunities for investment. So that's the first part. The second part is we put a lot of attention on portfolio construction and risk management. China A-shares and China equities are, of course, inherently a more volatile asset class than developed equity markets. And what we want to do is to avoid adding unnecessary risk on top of what is already a more volatile set of equities, and we do this in a couple of ways. We reduce the extent of our sector deviations. There's a lot of sector rotation within China A-share markets, and we want to mitigate the impact of that. And we don't take big single stock positions, so we have a very diversified portfolio. And the performance goal at the bottom here is really critical. We're aiming for consistent, repeatable returns. We don't aim to be the top performer over short time periods, but what we want to do is deliver consistent longer term track records. And the next couple of slides just bring this to life. So this is our China A-shares portfolio that we've been managing since 2009. So we have more than a decade experience investing into China A-shares, and the performance over all these long time periods you can see is very strong. And the next slide on all China equities, this is the one that is a kind of 50-50 balance between China A-shares and offshore, which we launched back in 2017, also has a similarly long track record. And a final slide here, which is full of numbers. The point here is just to look at the columns in green. This is the contribution of stock selection. Where we really believe we have our edge is in our research analysis and the way we do our due diligence, and we construct our portfolios. So this always drives our performance. If we get the stock selection right, we'll get outperformance. If we get our stock selection wrong, we will underperform. Unfortunately, as you see over the last 5 calendar years that we've fitted on here, it's the stock selection figures which always dominate, and the volatility effect of the sector allocation is really very small in the scheme of things, and it's a deliberate outcome of the way we design these portfolios. So with that, 3 quick points to conclude. China's equity markets increasingly being seen as a separate asset class as they become well represented in indexes. This reflects the size of the economy and financial markets in China. The future growth drivers of China's economy are going to be very different from the past. There'll be this focus on technology, data, science, everything that underpins the sort of areas that I talked about before in healthcare, for example. And Allianz Global Investors has a long history in managing both onshore and offshore China equity products. So with that, thank you very much for listening, and hand you back to Manqing to moderate the Q&A.
Yeah, thank you so much for the brilliant presentation. I think we got some really heated discussion in the question panel from our audience. So I'm gonna reverse our sequence of questions and starting with the valuation in the market. I mean, people are curious. We got 2 audience raising the same question. So we've seen some market correction since mid-February in Chinese equity market. What are some of the main drivers for this sell-off on the market? Is this an opportunity for global money manager to buy the dip, build up positions? What is your view on current valuation, and does earning expectation today support such valuation?
Right. So the catalyst for the sell-off was to do with concerns about the economy recovering too fast, inflationary pressures beginning to build, and therefore the need to tighten policy. The People's Bank of China has the same attitude to inflation as the Bundesbank. They are probably the 2 most hawkish central banks in the world, and the reason for this is China's most troublesome historical periods often coincide with periods of high inflation. So an anti-inflation bias is really deeply embedded into the People's Bank of China, which is the reason that they've had this orthodox policy in response to the economic in recovery. Having said that, I don't personally believe that, or more importantly, the People's Bank of China does not act as though it believes these inflation pressures are likely to sustain. Recent economic data in China has started to cool a little, and I think there's a very strong feeling that these inflation pressures are as a result of the dislocations caused by COVID, the big rise in commodity and input prices that we've seen as the global recovery continues, but this will moderate in the second half of the year. So I think we're unlikely to see much more policy tightening, and in fact, this is the reason why China equity markets have started to recover in recent weeks, as people's concerns about future tightening have eased. So that was the catalyst for the sell-off. Valuations, China A shares about 15 times PE in a historical context, a little bit above average, but I think it's still a reasonable level. If you were to find a point on this, if you were to ask me about forecasting China market returns, I think it's very difficult in the short term in China. But I'll give you one stat. I think when you invest in China, this is for me is a kind of long-term structural allocation, and in the 20 years to the end of December, so the 20 years this century, returns from China equities were 500%. Returns from European equities were 100%. And clearly in China equities, there are periods of volatility, and you have to be able to accept this volatility to invest into China A shares. But if you're willing to accept this volatility, then I think the long-term returns that we've seen before are likely to sustain into the future because of the sustained earnings growth that you're going to get out of China. So I'm not really sure where China markets will go over the next 6 to 12 months. They seem to me reasonably underpinned, but I prefer to look much further ahead because I think this is where you get the compounding effect from China equities. That's how I would say it. I hope that's okay, Manching.
Yeah, great. I mean, I'm also checking in the question panel. I think it's really great, active exchange of ideas. And we have some question regarding your view on the China-US relationship. I mean, the questions being the struggle between US and China about leadership in economics and political leadership all over the world is a big danger for the Chinese stock market, isn't it? I think we all are curious on your view. Will it profoundly impact the market? We see just yesterday, Biden signed off the executive order to revoke the ban on Chinese apps such as TikTok, WeChat, and Alipay, which was instituted in Trump era. And signs like this lead us to wonder will a Biden administration reduce the risk and premium of geopolitical tensions, or do you don't think it's the case?
I'm quite pessimistic on the outlook for U.S. and China relations, to be honest. And let me explain. Let me explain why.
Yeah.
I mean, to me, the worsening U.S.-China relations are a result of two economic superpowers starting to clash, and I think it's very unlikely that is going to stop anytime soon. And I also think being tough on China is one of the few areas that we could see that US politicians were able to agree on as they went through their rather tortuous election campaign last year. So the prospects of Biden going soft on China in somehow seem very unlikely to me. I think what might happen is we'll get less unpredictability. So we're not going to see US foreign policy and tariffs announced on Twitter, for example, going forward like we did under Trump. So maybe there's some degree of a little bit more predictability. But having said that, the US-China relationships have been deteriorating since the beginning of 2018. So we're now more than 3 years through this, and we have a good sense of how a deteriorating geopolitical relationship relates to the performance of markets. And in fact, the worsening relationship has clearly not impacted the performance of China markets, which have been quite resilient over the last couple of years. Where it has impacted is specific companies or specific sectors. For example, the big technology company Huawei. And I think this, at the moment, is going to be the most likely scenario, is a worsening US-China relationship. I don't think undermines the market as a whole, but it means you have to be careful about certain sections of the market. And therefore, it kind of links back to what I was saying about the way that you construct portfolios to take into account some of these unpredictable risk factors.
Great. So another question from the audience. The first one is, who is the main portfolio manager of the China-Asia strategy? I mean, emerging Asia, especially China, presents extremely favorable preconditions for active management. Many market segments are still relatively inefficient. The equity market there is still dominated, as you mentioned, by domestic private investors. And that's why a local team on the ground with strong country affinity is extremely important for the investors. And if you click on peer group on our Scope Explorer, you see more than 200 strategies in your peer group. Allianz Global Investors China related strategies are always top-notch ranked, which is quite impressive. What do you think makes your strategy unique or stand out compared to its peer group? And we have a second question of the same audience on the line. So maybe you can start with this one.
Okay. Thank you. Obviously, I like that question, and thank you for the kind comments about performance. To me, the point here is comes back to the consistency of returns. We design a portfolio so that we want to achieve outperformance, whatever the market conditions, whether we're in up markets or whether in down markets. We're very sensitive in terms of our portfolio construction, our attitude to risk at a portfolio level, at an individual company level. So we try and take out all the unpredictable risk factors. For example, if something happens to the Chinese tech sector, as it has done in recent months, or there's a big impact from a sudden announcement on US-China relations, or there's some other regulatory change in China, we don't want to be overly exposed, because these are very unpredictable factors. But they're there in the market. You can't ignore them, but you have to tailor a portfolio to cope with these situations. So I think this has been a point that in the down markets of 2018, the up markets of 19, 20, 21, through each of these different conditions, we've been able to add value. And ultimately, it all comes back to this question of being very selective about the companies that you include in the portfolio, the depth of research that you do, the analysis, the talking to suppliers, the talking to customers, the hard yards that the research analyst team that we have based in this office here do. And I think the collaboration between our research analysts, our portfolio management team, they're a very experienced team. They're all Chinese. They're all Mandarin speakers. The financial reports in China, they get published in Chinese, and you need to be on the ground to engage with Chinese management teams. So it's this kind of overall package that I think has led to the performance outcome that you were kindly talking about, Manjing.
Okay. Yeah, great. So another question is on, I think you covered some part of it. It's on the tech sector, recent like tighter scrutiny from the tech sector. And we know that China is going through a structural change, transitioning from investment-driven export economy to an innovative-driven economy, relying on its domestic consumptions. And you can see that from the chip industry. I mean, Chinese companies are raising R&D spending and becoming more innovative across many sectors. However, recently, the regulators have put a lot of pressure and tightened the scrutiny on domestic tech giants such as Alibaba, for example, for antitrust practice. And the IPO of Alibaba's financial arm, the Ant Group, was canceled, and some of its other fintech bellwethers are given 1 month to conduct so-called self-inspection. What are they doing? Why are they doing this now? And what does it mean for the tech sector and for the investors? What are the impacts?
Yeah. Yes, very topical, and agree with a lot of what you say. I mean, my interpretation here is that this started back in September last year, when Alibaba was about to launch its subsidiary Ant, which would have been the world's biggest ever IPO. And just a couple of days before that IPO was due to launch, it suddenly got pulled. And a number of reasons related to that. I think one of them was to do with this fintech issue that you mentioned. Fintech has become huge in China, but it's been very lightly regulated. And at a period when there's a lot of sensitivity to the level of leverage in China, this was genuinely perceived as a financial risk that needed to be controlled. So I think there was a financial risk part to it. I think there's a political issue here. The leaders of these internet companies are very high-profile personalities within China, and some of them were becoming increasingly vocal with their views, and therefore this is really a case of sending a very strong signal, I think, about who is in charge. So I think there's a political issue. I think there's a very significant social aspect here. As you know, there's a saying in China, 996. And 996 relates to the fact that you work from 9 a.m. 9 p.m. 6 days a week.
6 days a week, yeah, exactly.
Yeah, and there's a growing backlash against the pressures that come with working in areas such as these very fast-growing technology sectors, and you know, the backlash on social media is strong, and I think the Communist Party wants to be seen to react to this. There's been also a lot of publicity about delivery riders in China and the treatment that they received. A Communist Party official went undercover for 24 hours to see what it was like to be a delivery rider in China. He earned $6 US for a 12-hour shift and reported back. And all of this is capturing a lot of attention in social media in China. So I think there is a reaction to this. What I would say is, over the long term, I think many of these internet businesses, that they're still very high quality businesses. They're right at the heart of the transformation, China's economic transformation that you were talking about. They've created a huge amount of employment. They've added a lot of value through their innovation. So I don't think that this is the end for internet companies, but I do think it could be a period of consolidation that continues for a while. But you know, where one set of opportunities goes quiet, another set opens up, and you referred to the hardware side in your question as well. And I think we are going to see a lot of policy support in another area of the technology sector, and that's particularly semiconductors. China imports more in terms of semiconductors each year than it does in terms of oil. So China has a very big strategic dependency as it moves up the technology curve. The use of semiconductors is obviously critical, and as we know, we have these chip shortages at the moment, and China has lagged a long way behind in its development of this crucial component. So we're going to definitely see a lot of policy support and heavy capex into this area in China, which, you know, does create other opportunities for equity investors.
So another question coming from the audience is based on current valuations. There's a certain discount on Chinese equities in comparison to US equities, which is most likely based on the additional risk investing in China carries. How likely is that risk discount going to fade away in the years to come? And maybe you can also answer the question from another audience. Can you comment on the 2021 relative performance to benchmark? Do you have a growth tilt?
Okay. Valuations. I don't know if we will get a higher rating on China A shares in the future. I think in theory we should. The risk premium should in theory comes down as the market structure improves. There's a greater institutionalization of the market, more capital flows encouraged through higher weightings in MSCI indices. But let's say we don't, and we keep the current valuation. The fact that China's earnings growth is going to be structurally higher than the rest of the world, even without a higher valuation, means that you should get, over a long period of time, higher potential returns out of China than you do out of the US. The other thing about China is, when I look back over the last 10 years, actually the returns from China equities have not been, China A shares have not been great. So over 10 years, China A shares have returned 70%. Our China A share fund has returned 370%, which is a kind of a very powerful case, I think, for active management. And it also is a reminder that although the beta performance, the absolute performance of the market is of course important, the opportunity to add alpha and outperform in China equities is a lot higher than it would be in a more efficient market than the US. So that's the first point. The second point on our relative performance this year, so as of today, we're flat relative to the market. The period after Chinese New Year of the very sharp market correction led to a sharp market rotation. A lot of the sectors that had previously been winners or stocks that had previously been winners saw a strong period of consolidation. So that was a challenging period of performance for the fund, but it's recovered over the last few weeks. So kind of flat year to date. We do have a slight growth tilt, but actually, when you look back historically, there have been periods when value sectors have outperformed in China, and so has the portfolio. So actually, the style tilt of the portfolio is not a very big influence on its relative performance. In this case, it was a big reversal of momentum and a sudden one-off change. But it's recovered. It's recovered in the last few weeks. So we're pretty comfortable with where we are relative to the market and relative to our peers year to date as well.
Another question from the audience: who are the big players on Chinese stock exchange? Chinese people or money from foreign countries?
Oh, definitely local people. You know better than me, Manching, that people in China love to speculate in the markets. There are more investment accounts in China than there are members of the Communist Party, and people in China have a very different mentality to investing. They often think in terms of weeks or even days. Very rarely in terms of years. They are big fans of momentum and thematic investment. So the China mutual fund universe, for example, is full of thematic niche strategies, which if you saw them in Western markets, you might scratch your head a little bit, but they're very fashionable in China. And on a daily basis, about 80% of the turnover in Chinese markets is individual investors in China buying and selling. It's not institutional investors, and it's not foreign investors. It's a very domestic market in terms of the investor base, and it's also a domestic market in terms of the companies. So the vast majority of companies in China A shares get their revenues from China. And this is a kind of interesting contrast to if you think about the German stock market or European equities, where many of the companies that you invest into have global earnings. But in China, it's more than 90% of revenues are domestic. And this means that the economic cycle is different, the profit cycle is different. And this is one of the reasons why correlations of China equities remain structurally lower than the rest of the world. Yeah.
Indeed. So I think we will wrap up today's discussion with a question on the macro sentiment. And Asia inevitably led the way in the process of normalization, and China was the only major economy that has a positive GDP growth worldwide last year. But apparently, COVID is no longer the biggest tail risk now. The pandemic has been replaced by fears of inflation, market tantrum. What gives the edge to China in particular against other markets regarding this? Are there still enough tailwinds to support positive backdrop? Or what headwinds will continue to sustain such as?
Yeah. I mean, I think as I come back to this point that it's important to think longer term in China, and ultimately the positive tailwind comes from the superior earnings growth, and a couple of areas just to point to on this. The first is, I mean, you think about domestic consumption. You'll have become very familiar seeing Chinese tourists on your streets up until about 18 months ago, or you might have bumped into them at the airports at the tax rebate counter. I always remember in Frankfurt airport seeing these long queues, snaking queues of Chinese tourists waiting to get their tax rebates before they get on the plane back to China. And of course, you know, what's happened is this is now all bottled up within China because no one is traveling outside, but the consumption power is very much still there. So I think, you know, there are a lot of areas in China that are going to benefit over the coming period. You can think about hotels, domestic travel, entertainment, restaurants, and so on. And this kind of, you know, structural consumption power that we see out of China is obviously, is an edge, and it's going to sustain the growth potential. So I mean, I personally think, I don't think inflationary pressures are likely to sustain in China. I think we'll get an easing of policy, but very difficult to predict. Is it happening now? Is it going to happen in 1 month, 2 months? I think, who knows. Personally, I see any weakness as an opportunity to buy the dip, because I think the structural story is still there. But I think it's important to be able to accept the volatility that comes with this, because it is inherent in the market, and therefore to take a longer term view and look at the longer term prospects, as opposed to getting too focused on kind of short term, more tactical issues. That's the way I think about it. Yeah.
I think this is also part of our impressions that China is targeting a stable growth. The government has really gone extra miles to control risk compared to its developed peers, which will make the economy healthier in the long run and create good prospects for its equity market. And I think I was just like, there is still one question left for our investors who are looking into investing. What are the ways to allocate? Should investor look at specific, like pure China A-share investment, or all China solution, including both onshore and offshore equity markets? What does the optimum exposure look like?
Right. That's a very difficult question, because I think it comes back to the way that everybody individually constructs client portfolios, and it's the way that we think about tolerance to risk. But if you think about it, there was a very well-known global institutional consultant who published a report a couple of weeks ago, and they were recommending that in a kind of balanced global equity portfolio, there should be an allocation of around 10 to 15% in China equities. Now, that's probably quite a long way above where most people's exposure is at the moment, but kind of interesting that they come out with this figure, and that's roughly the same level that I said we should expect China to get to in the MSCI benchmark over the next 3 to 5 years. So there seems to be some kind of emerging consensus around this kind of aggregate level of exposure. Then the question is, how do you build that? As I said, if you don't invest in China A shares, you miss 70% of the opportunity. So you clearly want to have some exposure to China A shares when you think about this. Now, my personal preference is an all China approach, because I believe that offers a broader opportunity set, and it gives you a balance of onshore and offshore exposure. For me, that works, but it really depends. If you have existing emerging market investments, then you might want a China A dedicated portfolio to complement that emerging exposure. I think it really depends what the building blocks are that you have in place and how you want to take those forward. So it's either a China A or an all China strategy. That would be my view. Yeah.
Okay. It's very constructive, and I'm sure there's a lot more to talk on this topic. Unfortunately, we have to stop here in the interest of time. A very big thank you to William Russell, Global Head of Product Specialists Equity at Allianz Global Investors. Thank you for being here today and for the very lively discussion. So hopefully our audience will leave better informed and potentially excited for the opportunities in China equity market like you do. And we will be coming up with more feature segments in the next weeks on Asia capital markets. So stay tuned for our special series. And we will have a German version of summary on this webinar. So you're welcome to check up on our Scope Explorer webpage. I hope you enjoyed today's Portfolio Manager Conference, and have a wonderful day, and see you next time.
Thank you, Manching.
Thank you.